Hi, welcome to Money Without Myths, the show where we take everything that you think you know about personal finance and hold it up to the light. I'm your host, and today's conversation is one that I've genuinely been looking forward to for a long time. Our guest today is Renu Maheshwari. She has built a career not selling products but clarity. She is a SEBI registered investment advisor, certified financial planner, and the founder of Finscholarz. She has counseled thousands of Indian families on investing. If you have ever heard the phrase that financial planning is not about money, it's about life, chances are that her voice was in that idea. Renu ma'am, welcome to Money Without Myths. Thank you so much for making the time.
Always a pleasure, Deshna. This is a topic I love to talk. I'm happy to talk about it anywhere, anytime.
Thank you. And just before our call, right, I was actually pondering over how advisory has evolved over the last few years. 5 years back, our main concern would be, people relying on tips from WhatsApp, YouTube. Today, I am very concerned about people brainstorming with LLMs to build their own portfolios. I'd love to understand what's your take. What are the trends that you see? Where do you see this going?
So, where do we see it going? We don't know. AI will tell us probably, right? But the thing is, in India, we are at a stage where this advisory has come into play with the help of regulations. SEBI came out with regulations in 2013. So you and me are sitting over here claiming ourselves to be fiduciary and being able to run an unbiased fiduciary practice. But the situation on ground level is very different because people still don't know about us. So I'm happy you are doing this podcast, and that's why I also readily agree to talk about it. I want RIA name to go everywhere in the country. This is the only license which is available or which has been given by the regulator to work for the investor on the investor side with unbiased advisory. Why should we have advisory? Why not just do the way my parents did, your parents did? Well, your parents will be my generation. My parents did, my grandparents did. Uh, because finance is a technical subject.
Right.
How the money flows in, how the money flows out is very, very technical. And it's not the same story anymore when we say, I created a product with 1 rupee and I sell it for 1 rupee 20 paisa, and 20 paisa is my profit. That's not the way the world works anymore. That's not the way money works anymore. So it is quite a technical subject. So you need advice. Now, if you need advice, and I'm going to earn by giving you tips of some company or selling you a product or getting clicks on my website.
Right.
What will I be worried about? Am I going to be worried about you? Or am I going to be worried about where my money is coming from? Right?
Right.
So that conflict exists in the industry. Only RIs have minimized that conflict. And that's the reason we need to have that. And that's the direction that we want the industry to go. We don't want people to move away from WhatsApp tips. Well, earlier it was Panchayat tips, it moved to WhatsApp tips, and now to AI conversations. AI will tell you what AI has captured somewhere else. AI will not tell you what you actually need. So, as much as it's good to have some knowledge from AI, relying upon AI can put you in big trouble.
Right.
How do we see the industry going? The regulator would love IAs to have the model which can reach out to everyone. As a matter of fact, last time when I was having a conversation with the chairperson, also he spoke about, that, why don't you all look at ways of how do you reach to people through agentic AI or things like that. It's an exercise to be done, that how do we reach to every person in the country or have a bigger reach with the qualified advisors. Currently, what we see in industry, we have distributors, in industry, we have advisors, and then we have DIYs. I foresee that people will read more, people will see the economy growing, people will see the markets growing, they will get into the markets. And hopefully, right in the beginning, when they have few lakhs, they'll try to find an advisor and go, rather than burning their fingers and then trying to find an advisor. So I but I foresee industry growing leaps and bounds as the sunshine industry. Unfortunately, more people burn their fingers the more they need the advisors. That's a very unfortunate truth.
Yeah.
Someone was asking me the other day, what about the fee payment when the markets go down? And my answer was, when the markets go down and there's calamity in the market, the client is we get more clients. They're more diligent in paying up the fees
Right.
because it gives them a sense of security. So I foresee markets growing.
Hmm.
Which direction?
We'll have to see it.
We'll wait. We'll see how AI behaves and
Yeah,
how much we can use AI to make our services better and reach out to more people. So a lot will depend upon how the advisor and AI interact with each other, if I would say.
absolutely. Fair thought. So, all right, before we go into busting the myths mode, right, I thought we'll define a few terms which are
Mhm.
most commonly misunderstood so that all our listeners, you, I, are all aligned and we start on a fair ground. Fair?
Absolutely.
A few terms, in my opinion, would be returns, risk.
Mm-hmm.
We can talk about these two, and then there is diversification and
Mm-hmm.
liquidity. Just
Okay.
a brief understanding so that we are all aligned.
Absolutely. So you want me to tell you what these meanings,
Terms mean, yes.
these terms mean?
Yeah.
Okay. Let me ask you a counter question. What does risk mean to you?
Risk to me would mean, to be honest, it gives me risk is something that comes from uncertainty. If I'm not
Okay.
sure, it's a price, or a price in the sense it could be a positive price or a negative one that I pay for
Mhm.
taking on that uncertainty.
Okay, fine. So that's your semi-technical answer as well,
Okay.
right? As a normal investor, what would they think? Risk means what is their chance of losing the money?
Hmm.
Chances of losing the money actually gets confused. They confuse this with the risk of market volatility.
Right.
So these are two different kinds of risks. One is I lose the money. Second is markets go up and down, and I need to plan around it, right? Risk means all of these things put together: volatility, chances of losing the money, illiquidity, not having the money at the right time. All of these constitute risk in your investment, and a common investor should be looking at that. The biggest thing which Indians don't look at is the illiquidity risk of real estate,
Right.
inflation risk of FD.
Hmm.
It just doesn't register in our mind in
Hmm.
India. And that's the biggest risk, if we would ask.
Right.
Okay.
If we
Then
had,
let me talk about returns.
yes.
Again, I'll ask you the question. What do you mean by return?
What's my by return? I would, in layman terms, I would just think about what did I get for taking on that, decision to make an investment. What is my reward for it? So I
Absolutely.
necessarily think of it as positive, but I
Exactly.
understand it doesn't have to always be.
Absolutely. Now, year one, you have a return of 20 rupees.
Hmm.
Okay.
Hmm.
Year two, rather, I would put it this way: you invested 100 rupees.
Hmm.
First year, the market went up by 20%, you made 20%.
Right.
Second year, markets came down by 20%. How much money do you have at the end?
I have what I invested, 100.
Not really.
No.
Because your money went from 100 to 120 and then it came down by 20.
Right.
That's 20% of 120 now. So it
Right.
came down by
Hmm.
24.
Right. 20%. Sorry, I got it as 20.
Right. So 96. No, no, don't say sorry. That's a common thing we all do.
Right.
I mean, before I did this whole course and everything, I also did the same thing, right?
Hmm.
Now, if you will ask anyone, what are your returns?
Hmm.
Average returns. First year, you had a markets went up by 20%. Second year, markets came down by 20%. What would be the common answer?
If
Zero.
zero, right? Yeah.
Right? That would be the common answer. People will say, oh, I didn't make anything. It went
Right.
up by 20%, it came down by 20%. But you see the numbers, it went up by 20%, it went to 120, it came down by 20%. Now I actually have 96, and my
Right.
return is minus 4% in
Right.
over 2 years. Average would be less than around 2, little more than 2, minus 2,
Right.
right? This is a problem with numbers. This
Hmm.
is a problem with return numbers. So
Right.
every time we think of return, then we are doing what we call arithmetic average most of the times. Intuitively, we all do arithmetic average. And as simple as it may sound, this is what makes us take wrong decisions.
Right.
Because when people say I invested this much in real estate, my grandfather bought it for 500 rupees. Today it is 2 crores. Oh, can you imagine the number of times I've made money? But boss, it's more than 100 years. Just calculate it and see what the number was, and you had a risk of illiquidity. These two things put together, not being able to comprehend the risk of not having the money when you need it, and not being able to calculate the right return number. These two things put together gives us an absolutely, sorry, I'm not able to think of a very sophisticated word, but a screwed up answer.
Right.
Okay. It's an absolutely wrong answer that I get. And it's an absolutely disastrous decision that I end up making. So when we talk about financial literacy and people say, hey man, what should we learn? Which book should we, where should we invest? I said, forget about everything. Just understand these 2, 3 basic concepts of risk, return, and you spoke about asset allocation and diversification.
Right.
These are the 4 things we were planning to talk, right?
Liquidity.
And liquidity. Yeah. So liquidity also.
Yeah.
So these 4 things, if you understand this, you would have won 75% of the war and you would end up making good money.
Right.
This is because the longer is the term, the longer is the aberration in your answers and the worse kind of mistakes you make.
Right.
Right. So these are the 2 things of risk and return. I always communicate anywhere if someone asks me. At the risk of repeating myself again and again. Third thing, what you're talking about is diversification and asset allocation. Sometimes people think I get 100 schemes in equity funds or 10 schemes or 20 schemes and I am diversified. Diversification means you need to have asset classes which have negative correlations. In layman terms, if one thing goes up, if one thing comes down, other thing goes up.
Right.
And why does this concept work? Because at any point in time, there will be something which will make money in the market. As long as human being is alive,
right,
there will be economic activity. And that will make money. Even when there is war, people are making money in petrol and defense products.
Right.
So something will always make money, and that is what diversification or asset allocation is supposed to target. That means always have the right mix of products or asset classes rather, so that you have a steady growth of wealth.
Right.
That steady growth will give you more money as compared to volatile, high risk and high return things. So on paper, it may look like equity market has gone up that much, but in reality, how much money did the investor make is the question.
Right.
And why doesn't the investor make? Because the investor is busy chasing. So you can never get into the market at the bottom of the market and get out at the top of the market. How do you fight that out? By doing asset allocation. That means you tide over these volatilities with one particular asset class. You have one asset class which is volatile, let it be volatile, but you have other asset class which is providing you steady returns. Third asset class which provides you a hedging against all the uncertainties of the world. And fourth asset class which gives you illiquid but still a growth prospect. This mix will vary from you to me to my son, my husband, and everyone. Right. And that mix becomes the biggest source of your wealth creation. Someone said, 90% of your wealth comes from asset allocation.
Right.
There are, discussions about what he meant, what he did not mean. But if you look at it, 90% of your volatility, etc., is explained by that. Now, if you are able to create the right allocation and move certain portion of monies into the low-priced asset, you will make more money with much lesser risk. We've been able to do that in the portfolios.
Right.
long-term portfolios, balanced portfolios of 70-30 or 65-35 have given higher returns than Nifty 50 or Sensex.
Right. That's a very interesting point, right? And we'll definitely delve a little deeper into this. There are a few more, follow up, but glad that we established the foundational concepts so that we are all aligned now. Why
Yeah,
don't I start by talking about the myths? I'll state a myth, I'll give you a little context about what I'm trying
sure.
to say, and we'll
Sure.
discuss,
Okay,
dive deeper into it, right?
go ahead.
So, the first myth, SIP is an investment product. This is
We just,
a
yes,
myth.
please complete.
Because why do I say that? Because I interact with a few folks. You yourself have been in the industry for long. People start SIPs and think that is it. That's the financial plan, right? So,
Right.
what is exactly wrong with this approach?
The good part about SIP word is it says sounds sip.
Hmm.
Okay, so what do you do when you sip? You take a little at a time,
Right.
right?
Hmm.
Now it depends whether you are sipping a juice or tea or coffee or water.
Right.
It's just like that.
Hmm.
SIP is systematic investment plan. That means the money is going out of your bank account at fixed interval. It can be daily, it can be weekly, it can be monthly, it can be quarterly or half yearly or annual, any fixed interval into the product where you want it to go. Now
Hmm.
that product can be anything. As a matter of fact, a bank RD is another form of SIP.
Hmm.
And your SIP can be into anything, a debt fund, a multi-asset fund, a equity fund, etc., etc. So friends and folks and all your audience who is watching it, SIP is not a product. SIP is a methodology to invest in a product. I will take this line to the second one, which I don't know if you were planning to ask or not, but I'll just preempt it, is mutual fund. Mutual fund is not an asset class. Mutual fund is a methodology to invest in certain asset classes
Right.
and products. So your returns and your risk will depend upon where it is taking it. So
Hmm.
understand, SIP is a methodology, mutual fund is a tool.
Right.
None of these are products or in your financial plan.
Definitely understood. This part, very thanks for articulating it so well. Just a follow up to that, right? Someone who's thinking of setting up an SIP for the first time, it's definitely a methodology. Understood. Is there a way that they can think about the 0 to 1 journey on how to decide which one would be the right one for me?
Okay, so someone who's just started working,
Hmm?
let me take it from there.
Yeah.
And the first step should be they create an emergency fund, and after that, they start thinking about an SIP in an equity fund.
Hmm.
They should start it with BSE Sensex or Nifty 50 SIP. That's
Oh,
it.
simple.
Simple.
Yeah.
Okay.
About the emergency fund number, right? It gets a little misunderstood. And what if there's a rule of thumb? I usually have heard this a lot that 6 months of expenses, right? You set it aside as your emergency fund. Is that the right way to think about it?
Yeah, so it is 3 to 6 months.
Okay.
It also depends on what kind of emergencies that you can have. For
Hmm.
example, someone's children are in US.
Hmm.
You always say your emergency fund is not just 3 months of your expenses, but also an emergency ticket to US. Yeah,
Right.
I mean, the child is in US, you have to go, or something like that.
Hmm.
Or someone has elderly parents at home. You may
Right.
have sudden hospital admissions and you may have to shell out few lakhs or something like that. So
Right.
3 to 6 months is okay,
Hmm.
but these are the things that need to be looked into, the life situations and the other kind of emergencies which may be there. The biggest thing is for the youngsters to
Hmm.
have this 3 to 6 months is because that saves them from getting into personal loans and credit cards.
Right. Hmm.
Some emergency, some forget emergency vacation plan and they say, okay, let's borrow a personal loan.
Hmm.
Never do that.
Right.
Emergency fund is meant for emergency expenses.
Hmm.
Don't borrow so that you don't end up borrowing.
Right.
So what can be your emergencies? You will have to figure out. three
Hmm.
to 6 months is fair enough.
Right. All right, I'll move on to the next myth. Past returns are the most reliable way to pick a fund, right?
Exactly.
This is,
Definitely. That's the most favorite, most
followed myth, I think.
followed disastrous myth, most dangerous myth.
Right,
Okay. The problem is past returns, what drove those past returns. That is what is very important.
right.
Right? So suppose it was because of the fund manager's active stock picking,
Hmm,
then it's a good idea to, that then it's a really good parameter. But
hmm,
the markets went up or the mid cap went up and that fund made money.
hmm,
So that's not the right approach at all. Although it keeps saying on every statement, past returns are not a guarantee. People just look at it as a packet of just like it's written on pack of cigarette,
hmm,
it's dangerous. Cigarette smoking is dangerous for your health, and they just choose to ignore it.
yeah,
So never go by that. It doesn't mean that you should not look at it. If you have to look at it as a parameter, compare it with other similar funds,
right.
compare it with the index. These two things are the ones which will give you which will give you a glimpse into that it is the fund manager's performance or is it the market's performance, and then you make a choice. And that's what you need to understand, that there are different companies, different groups which will go up or down together.
Right. So probably a few follow-ups to this, right? I'll just
Yeah.
fortify my understanding. What I gather is it's a good starting point. If a fund has performed well, it's
Yes.
a good starting point. You can go back to it, understand what drove that performance. If it's a fund manager's skill that has done well, then it's a good idea to go ahead and invest. Why not compare it with other funds as well? If it's just a general market has performed well and it did well, then it may not be the best idea to continue investing or just think through it again, probably. Any other signal that I should look at uh,
Yes.
when I'm picking a fund?
Exactly. So see, when you are saying that best performing fund, etc., it changes on a monthly basis,
Right.
right? So don't keep jumping from fund to fund,
Hmm.
first of all.
Right.
Second is that's not the criteria for you to get out of the fund either.
Right. Okay.
Or if you will look at it over a long period of time,
Hmm.
most of these decent fund managers, and
Hmm.
I'm talking about, top, not just top one or two, I'm talking about top five or 10.
Hmm.
Over a period of 5 to 10 years, they would all do the same.
Hmm.
Okay. So
Right.
the stocks that I have picked up,
Hmm.
that if they have not done well today, they'll do well tomorrow.
Hmm.
So, that sort of a thing. So when you are creating your portfolio or when you are choosing your scheme, uh, I'll go to the other semantics later on, that choosing a scheme should not be the first step. That is the last step in choosing your product.
Hmm.
But nevertheless, while we are talking about choosing the scheme, when you're choosing the scheme, your criteria should be that you find a decent fund house which has got consistent performance.
Hmm.
Take that and then stick to it. Until and unless you get negative news about that fund house, fund manager, that's a different thing.
Right.
Otherwise, stick to it. No need to keep jumping from one fund house to another.
Right.
Second thing, if this fund for any reason starts performing badly, or you hear that this is not in the top quartile, maybe you can move to the other ones, but don't keep withdrawing, taking the money out and moving to someone else, something else.
Right.
So if the fund manager has also gone wrong, try to inquire what happened,
Hmm.
and should you wait it out,
Hmm.
you take it out. So those
Right.
are the things that you need to keep in mind. Don't jump onto from one scheme to another.
Got it. Noted. Just one last thing about this, right?
Mhm.
You also called out the analogy very well about the, disclaimer on the cigarette packet. It's the same
Yes.
thing. Every video says this, that past performance is not an indicator of the future. It goes unnoticed.
Yes.
Why do you think this is so? Is there a better way to do this?
I think investors are driven more by behavior and beliefs rather than real facts.
Hmm.
I don't know what can be better. I think that we need a communications experts and people who dwell into behavioral science of people who
Mm.
can probably put it. I mean, it's written in black and white. Past
Right.
performance is not the guarantee, but
Mm.
that's where we look at. I think it's communicated. It's communicated absolutely in a accurate manner.
Yeah.
It's people. People need to understand and stop being the victims of their own emotions.
Absolutely. Yeah. All right. I'll move on to the third one. We scratched the surface a bit with this, but I'll just delve deeper into this.
Yeah.
That more mutual funds in my portfolio means I'm better diversified. This is the
Now, yeah.
But I personally have seen portfolios where there are more than 18, 20 mutual funds someone is holding. I want to understand and probably just articulate through you what exactly is the risk of, this approach, what exactly is not the right thing about it.
So when you say diversified, what are you diversifying? Right? So you are diversifying amongst asset classes. That's
Hmm.
the first level of diversification.
Right.
And that is, so then you need to look at how much of equity, how much is debt.
Hmm.
Within that equity, then what are you diversifying? You're diversifying across companies, mid cap, large cap, small cap, right?
Hmm.
Within mid cap, large cap, small cap, what are you then diversifying? You're diversifying against the fund manager's performance and the passive thing. You want to have low expense ratios, but you still want to capture the upside of the market, right?
Hmm.
So, point of diversification is that you are able to diversify your risk.
Hmm.
It's not going to happen with 20 or 25 funds. Sometimes people end up accumulating that because of various reasons, but it's not productive. Productivity is just make sure that you have diversified the classes that I said,
Hmm.
four asset classes: debt, equity, real estate, gold.
Right.
In gold, now you can invest with sovereign gold bonds. Okay, they are not there anymore. So now ETF is the only way left,
Right.
right? Within real estate, do you want to buy REITs or do you want to buy physical real estate?
Hmm.
Within debt, how much fixed deposit, how much debt mutual fund, within debt mutual fund, then long duration, short duration, etc. Now,
Hmm.
those are in calls made based on the interest rates and durations. Usually, a layperson doesn't is not able to take those calls. So,
Right.
if you're doing it by yourself,
Hmm.
just make sure that you keep the diversification to these two labels,
Hmm.
asset classes, and then within asset classes, this large, mid, small, and
Right.
go by it. Don't go for 20, 25 just by looking at the name of a scheme that, okay, ये वाला मेरे पास नहीं है, इसको भी खरीद लूं थोड़ा सा. That's not the right.
That's not correct. Yes. सही है. I just wanted to, थोड़ा और re-emphasize on the potential risk a person is taking. For example, a hypothetical situation, someone has invested in 15 flexi cap and large cap funds, right? What is the level of, overlap that they're looking at, and why is it dangerous in event of a market crash? I just wanted to, emphasize
Okay.
that a bit.
Okay, on the so see what happens is now, like you are saying, 15 flexi caps, because sometimes there are certain schemes which get sold
Hmm.
together in the market. The problem is the number of schemes. Then let me put it this way: it's not the problem of number of schemes; it's the schemes within the same asset class or the which gets piled up in one portfolio,
Right.
right? The problem with that kind of a more number of schemes is that when it comes down, everything will come down.
Right. Right.
And that diversification doesn't help you. As a matter of fact, there is no diversification.
Yeah.
There's no diversification. So diversification means that you take schemes
Hmm.
of different character altogether.
Hmm.
Technically, what we say, coefficient of correlation should be negative,
Right.
not low, but negative.
Okay.
And that is what diversification means.
Hmm.
But buying 10 schemes of the same kind got no purpose. It has got no purpose. You're
Right.
just making it difficult to track. You will not be able to see what the fund manager has done.
Right.
You can't track so many fund managers.
Yeah, absolutely. I think that's a fair thought and well said. And hopefully this helps to all helps listeners. Please try to consolidate and understand what true diversification means before you buy a lot of products, right?
Exactly. Yeah.
So, all right, I'll move on to the next myth.
Yeah.
Mixing insurance and investing is a smart practice. Right. So I think this comes to give you context about why I thought about this as a myth. People think about endowment policies, ULIPs, they get sold a lot of these, right? And think of it as almost equivalent to investing. I personally am of the opinion that, it's not the same. And because the whole industry's distribution model is running, it's just being marketed that way. If we could help users understand what fundamentally the model is, how it may be beneficial, and why is it not exactly investing.
So see, insurance is not an investment. That's the first thing.
Right.
Insurance is a risk management product, so you protect the downside of your financial risk, right? That's what insurance is. Investment is opposite to that. It is that you put your savings and where the money grows. Now, when you put both of these things together in one product, neither your risk is covered. Because to have a term insurance or to have a cover of 2 crores of insurance money, and if you add it with investment, your premiums will be super high.
Right.
So in a regular scheme, then neither your risk is covered nor the investment happens properly, because all these products have to invest money in a manner that the money is safer and available, etc., etc., and they cannot give you return. They cannot, most of these endowment policies and money back policies and whole life policies run a range of return of 4.5 to 5.5%. Will you ever put your money into a product which tells you I'll give you 4.5% for a long term? No way. But this is the way it gets invested. You
Right.
just put in 5 lakhs, ma'am, 1 lakh every year for 5 years. After that, you don't have to give anything, no? And then after 20 years, you will get 1 lakh for 10 years. Can you imagine you are giving only 5 lakhs and you will get back 10 lakhs and you also are insured? All those are communication, lots of numbers, lots of communication, because there is no substance.
Right.
The more the numbers, the more investment banker is making more money and we are not as an investor.
Right.
This is something, this knowledge not being available to a common man has hurt lots of people's lives, and people just keep buying these policies and it does not help them. By simple, we have been talking about it now for last 20 years. Lots of people's lives changed because we did analyze these policies, told them what's the right process to get out of it or do about them. Simple thing is, you need life insurance. When you don't have enough funds and there are people dependent on you, you need insurance to be able to cover their financial needs. Go out and buy a simple term insurance policy. Once you stop working, that means your physical body is not functioning anymore to make money. You should not buy any insurance policy, because that insurance policy, that life insurance policy, is against your body's function not being able to perform, and safeguarding your dependence on that. So post-retirement, zero insurance. Second thing is, if you don't have financial dependence, you don't need insurance. For what do you need it? For example, between me, my husband, my son, we may be earning whatever, but we have zero life insurance for a simple reason, because if something happens to me, financially, no one's life will get affected, and vice versa. For all the three of us are financially independent. Fourth thing is that this insurance, as your money grows, your insurance needs come down, not vice versa.
Right.
Just because your salary has gone up and you should buy more insurance, no, not like that. If your salary goes up, you should save more and invest more, not buy more insurance. Okay, so that's the basic principle of insurance. investment is done separately. It should be done separately. If I give you numbers, they're mind-boggling. Suppose when you're getting married in your 20s, someone gives you a gift of 1 lakh rupee and you invest it in insurance policy, or do you invest it in the market?
I would have invested it in the market, but if I hadn't known better, I would have bought insurance. Yeah.
Exactly. How much difference do you think it can be?
I didn't catch that. Sorry. How much?
How much of a difference would it be by the time you retire?
By the time I retire, a significant, I would say 1 lakh compounded over 10 years, more than 50 lakh of difference, I would personally see.
Easily, much more.
Yeah.
Much more. You know, I'll give you this number, and this is again one of my favorite things to talk about everywhere. There is something which we call doubling period, right? How much time it
72
takes the
divided.
money to double, right? And on an average, we say in the market, equity market, 6 years, probably, right? How much time will it take in an insurance policy?
It will take almost double, I guess.
No, it
No?
will take almost with 5% also about 12 years. Right? Here it's taking double. 6 years and 12 years, right?
Yeah.
Now, a human being's life is limited, right? Say you start working even if you start working at 25, will work say up to the age of 60, suppose.
Right.
These are 35 years of your working age. You've got only those 6 doubling periods. If you are investing in equity, you have 6 doubling periods.
Right.
If you are investing in this insurance policy, how many doubling periods? 3.
Yeah.
The difference it makes is 1 to 2 to 4 to 6. 4 doesn't go to 6. 4 goes to 8 and 8 goes to 16.
Right.
So 3, it takes the same amount of time for 1 lakh to become 2 lakhs, 10 to 20 lakhs, 1 crore to 2 crores, and 10 crores to 20 crores.
Right.
But 10 crores to 20 crores is 10 crores of rupees in your hand.
Right.
And 1 lakh to 2 lakh, you have this little doubling. Right?
Yeah.
That's where when you have 3 less doubling periods, it is a difference between retiring as a pauper or as a king.
Right.
It's that level of difference.
I think this math analogy really cleared things out, and it's very simple to understand. It's just, we've been missold. I personally think so too.
Yeah.
It's something that needs a lot more attention.
Exactly. See, so this is what happens when you have commission-driven markets, totally commission-driven markets, and it's a legitimate business. I'm not against it, but I'm glad regulators are also waking up to that, and RBI came out with these restrictions on how much commissions can be paid. Because ultimately, if the investor doesn't benefit, then we will not have a capitalist market, because investor should be willing to put in his trust and money into the market.
Thank you so much. You've been incredibly generous with your thinking today. Thank you for sharing that. Before I just let you go, a few questions. It's a rapid fire. Please feel free to answer in a word or a sentence. I'll just keep it really short.
Sure, I'd love to.
Yeah. One word for what most Indian portfolios are suffering from right now.
Illiquidity.
Gold in a portfolio, is it an allocation or a sentiment?
Both.
The most underrated personal finance book that every retail Indian investor should read.
Jago Investor.
Right. The author, please?
Okay, I'm not able to remember his name, Manish or something like that, from Bangalore. And he wrote it long time back. That was the first book he wrote, and it's still as relevant as it was at that time.
Oh, very interesting. Jago?
Jago Investor.
Jago Investor. Got it. The one financial behavior you see most distinctly in clients who actually build wealth versus who don't.
They're cool, calm, collected.
If you could complete the sentence, wealth is not about
money.
I think this is what I had in mind. I just wanted to quickly go through this. And thank you so much for sharing all those valuable insights and definitely a lot of actionable takeaways for our listeners today.
Thank you very much, Deshna. Always a delight to talk about my favorite topic, and pleasure talking to you.
Thank you. Thank you so much.
Very much.
Here is the thing about myths. They don't feel like myths when you believe them. They feel like common sense. So the real question isn't whether you believed something wrong before. We all did, right? The question is, which is the one you are yet holding on to? Start thinking about it, sit with it. That's where the real work begins. I'm Deshna. This is Money Without Myths. Until next time.